Well, good evening everyone, and welcome to this ATAA remote chapter meeting for the 31st of October. Tonight it's my pleasure to introduce to you Igor Vasiliev. He gave an excellent presentation at the Sydney chapter, and I invited him to speak to us tonight because we were so impressed with what he was saying. So I'd just like to give you a background to Igor. He's a full-time stock market investor. His favourite approach to the stock market is a combination of value investing and option trading. In addition to vast trading experience, Igor has a unique set of qualifications. In 1996, he graduated as a medical doctor as a psychiatrist, but he didn't spend much time working as a doctor as he started his own wholesale company and fully devoted himself to his business. But the knowledge and understanding of human mind and psychology still helps him to understand the madness of Mr. Market and make logical decisions when many traders let their emotions dictate them what to do. In 2000, Igor moved to Ireland, where he spent 11 years, and he obtained his second qualification there, an executive master in business administration. And this degree always helps Igor to better understand companies' activities and make less mistakes when he buys their shares on the share market. Igor then started another company and established several furniture showrooms in the west of Ireland. During those times, Igor started his stock market trading career too. Once he arrived in Sydney in 2011, he obtained his next qualification in finance and accountancy, enhancing his ability to analyse businesses, which is very important when you're looking to invest in the best businesses when they are undervalued. So Igor has a very interesting background, a very background, and one that obviously assists him with his what he's going to talk about tonight. So Igor, could you just go to the disclaimer and I'll read that, and then we can move forward. Excellent. So I just have to move something so I can read it myself. So the ATAA provides general material and information through presentations and publications with the aims of promoting the theory and practice of technical analysis and assisting its members to become more competent technical analysts. Any material or information provided is made available for general personal use and education only. The ATAA makes no warranties as to the accuracy or completeness of any information provided. The information provided does not constitute financial product advice. The ATAA makes no recommendations to invest in any financial product nor to use any particular methods of investing. It is strongly recommended that you seek independent professional advice before making any financial decision or proceeding with any investment. The ATAA directors, affiliates, officers, employees, agents, contractors, successors and assigns will not accept any liability for any loss, damage or other injury resulting from the use of the information provided. The information provided may include views and statements of third parties and do not necessarily reflect the views of the ATAA. The ATAA has taken all care to ensure that the material presented or published is based on information from sources that are considered reliable, but takes no responsibility for the relevance and accuracy of this information. Further, the presence of any third-party material does not constitute an endorsement of the material itself, nor any associated organisations, products or services. So I'd like to welcome everybody here on this webinar tonight. Thank you for attending, and a very special thank you to Igor, because I know that he did have a bit of a clash with other important matters, and so I appreciate that he is able to speak to us tonight. I know you're just going to enjoy this. I too am an advocate of options, but I'll let Igor tell you all of the special benefits of trading options. So I'll pass over to Igor. Thank you very much, Igor.
Okay, thank you, Daryl, for an amazing presentation. It's very nice when somebody speaks so highly about anyone, especially about myself. Okay, thanks a lot. And guys, can you please put the plus or something like that you can hear me fine? And in this case, I will continue our presentation. If you put in chat that you can hear me. Okay, audio is good. Okay, great. Okay, fantastic. So, guys, tonight we're going to talk about very interesting topic about selling naked puts. A lot of people consider it to be quite a challenging area because probably if you read about options, when you sell naked options, any kind of options, or call option or put option, it's considered to be the most risky strategy. And tonight I am going to explain you the way I approach this strategy and how I make money. And my approach is a combination, as Daryl said already, a combination of analyzing of underlying security. So basically I usually sell naked puts on the stocks, US stocks. And I'm going to show you several examples tonight and trying to explain the step-by-step guide which I use. It's like a checklist which I follow before I make any decision on using this strategy, specific strategy. Okay, great. So what we're going to cover today, we're going to look at when and why we use this strategy. It's an important thing to understand. The next one, we're going to look at risks and limitations of this strategy and how we reduce them. Also, we're going to look at how we choose the underlying stock for this strategy and how to choose a correct duration of the option contract, because probably you're aware that option contracts, they have different duration. And then, of course, how we choose a proper strike price according to your risk tolerance and kind of whatever you would like to do in the future, your kind of long-term strategy as well, and what kind of returns you can expect when using a strategy, and also the most probably important part, how we create our plan B, or what we can do if our position didn't go as we planned it to go. All right, guys, before I start with options, I'd like to ask you, put from 0 to 10, how you can assess your experience in options. If you put 0, it means you have no knowledge about options at all. If you put, let's say 5, you kind of knowledge. If 10, you believe that you have extensive knowledge of options. All right, Martin, 6, Mark 6. Okay, great, fantastic. Okay, 5. Okay, we have great experienced audience here. That is great. So in this case, I will probably go in more details and more specific, kind of more step away from the basic kind of coverage. All right, great. Now, as Darren mentioned, I have several qualifications on it, and I believe that trading success is based on several things. Okay, first of all, a proper mindset. It is very important to understand how to act on the market and how to identify where the prices of underlying securities they go like based on emotions. And I presume everyone knows in this world that you have to buy low and sell high, but in the practice, when the market goes down, it's quite challenging to buy shares and everyone is selling. It's kind of go against the crowd, and our nature, our subconscious mind trying to dictate us that you have to follow the crowd is kind of the safest way, so which is absolutely incorrect on the stock market. So we have to make different decisions sometimes from the majority of people in order to make the better returns. The second one is understanding of your strategy in details. And tonight I'm going to show you the only one strategy. Actually, I'm going to cover a couple strategies. I will be probably briefly speaking about another strategy which is called selling covered calls. I'm sure you know and aware about the strategy because you have quite a few members in your chapter, at least in Sydney chapter, who using covered calls, especially Sam. He uses kind of covered calls all the time, and he explained it several times during ATAA meetings. Okay, so, and then important part is correct implementation of this strategy. The interesting thing that I've been trading for quite a while, and in my environment, I have a lot of friends who trade, and every time when we analyze their mistakes, when they come and say, look, I've done this trade and for whatever reason it didn't go like in a way I wanted. So when I analyze this deal, majority of time is incorrect implementation. So when we look the entry point based on technical analysis wrong, or the company wasn't analyzed fundamentally, or something wasn't right there. So the person just didn't implement the strategy which he was aware of. Okay, this is very important part. So if you keep in mind this type of three kind of important circles that you have to be like mentally prepared to do trading. Like I don't know how many years you guys already trading, but probably you all know that if you're in a bad mood or you had an argument with someone, it's better not to touch the market. Especially it's in my case if I know that I had a difficult day and some kind of maybe issues around that happening. So usually I just stop. Like I even don't open the trading platform at all. So it helps me a lot. All right, so let's have a look at emotional roller coaster, which is very, very important to understand when you're selling puts and when you're buying shares as well. It doesn't really matter which strategy you use, but you need to understand how people feel during that, majority of people. I understand, guys, that you have already quite a lot of experience, but if you try to remember yourself when you were just starting trading and what emotions you experienced, probably you're still experiencing exactly the same emotions, but if you talk to the beginners, the traders who kind of started trading, you probably will see something like that. So eventually, initially, when they buy shares, like majority of people, they're optimistic about that. They want to buy shares because they believe that this particular security is going to go up, okay? And then if they are right, if they kind of use proper approach and everything, the share price or any other security start going up, they feel enthusiastic about that. And then when it goes even higher, they are really fascinated about that. They start talking to everyone about how great the stock market is, how fantastic. They're telling that we've bought only a week ago the share or something else, and it's already made 5% profit. So they talk to everyone, and that's where majority of people start following their advice and start jumping on the market, start buying these shares, and as a result, they entering the market at the highest point of danger. Because when everything is high, it seems like really secure because we have a past like few weeks or maybe days, depends on the strategy, but a lot of people, they'll still enter their trades here, right here. Okay, so majority of uneducated people buy shares at the top, all right? And the interesting thing that this is a maximum risk of losing invested capital. Okay, so this is, then when the shares start going down, first of all, it's kind of unease. They think, okay, maybe it's going to turn around and move up like further. Then already when it goes lower, they kind of deny it. All right, they definitely now has to turn around because it's kind of not right. I bought the share in the proper way, and now the price is exactly the same as I paid for this. All right, but when it goes slightly lower than they paid for this, there is a panic on the market, then eventually they give up. Okay, they think, okay, stock market is not for me, not stock market, any trading activity is not for me, and I'm going to quit this stuff. So, and what happens? They start selling. So majority of uneducated traders, people sell shares at the bottom. All right, and the interesting thing that this specific point is actually has the minimal risk of losing invested capital, because at the bottom of the market, you probably know if we buy at the bottom, it's already has less risk than when we buy in even somewhere in the middle of the trend or something like that. So that's, if we go on the top, at the very, that's where we buy put options, we buy insurance, and at the bottom, we sell put options, we sell in insurance. You probably understand how put option works. In any way, I'm going to explain that once again, but still. So that's the area where we sell put option. It's very important to understand that if you use analysis, we're selling put options only at the place where we believe we would buy an underlying asset. Okay, that's the thing. So if you decided to sell put option, it means that alternatively you would buy an asset at this specific point. I never ever sell a put option at the top, where I'd never ever sell the put option when the market at the high. Okay, so it is kind of one of the key points. All right, so let's go what the put option is. I presume you understand when you trade any security, there is a buyer and there is a seller. Okay, so in this particular case, if you are a buyer, you buy the right if you are buying the put options, but not the obligation to put or sell your shares at a fixed price, which is strike price, by fixed date, expiry date, okay, to certain person. So that's the agreement. That's why you are paying money for. So it's when the person selling put option, they giving obligation to the person who bought the put option to buy shares at a certain price until a certain day. Okay, so that's basically how it works. Okay, so let's have a look at this specific example and to see how it works. Now, imagine this kind of trend line, okay, and that's what we can see. And I'm going to compare selling put options in this particular example with buying shares. Okay, guys, just the question is, because part of my screen is covered by some kind of thing, and I don't know how to get rid of it. Just a second. Okay. No, just a second. Can you guys see the screen in this way? So I get rid of the line. So, but I don't see now your...
It's okay, Igor.
Okay, you can see it, yeah? All right, okay, great. Thanks for telling me. Okay, so I'm just going to close. All right, so that's what we imagine, that's the trend, okay? And we can see that particular share is trading between $10 and $11.50. Sometimes we can see that share reaches maybe $10.50, sometimes it goes to $11.30, sometimes it goes all the way to $10. So we can see that in when the wave is big, it goes from $10 to maybe $11.60, and in majority of cases it doesn't go to $10. So that's what we see right now. Okay, $10.50. So what we're going to do, if we see all the indicators are showing us entry point, and we already saw that several times during last like 6 months, for example, we can see that the share price bounced back from $10.50 around maybe here $10.80, and now again at $10.80 level. So what we can see that the share price bounced and go back to $11.50, so we can make profit by buying shares, or it might continue to slide down. And in this case, if we buy at $10.50, we're going to incur like capital loss because the share price is going to go down. And in this particular case, based on different strategies, you can hold the share and wait until it recovers, or you can use the stop loss in order to exit the trade. So what do we do here? And let's have a look at two strategies. One of them is just buy shares. Okay, and another strategy is selling put option. Okay, and examples like that. So if you decided to buy shares at $10.50, you make a profit only if the share price goes up. Okay, so it's like basic of the trading. So if it goes up, you make profit. Now, share can go to $10 as well, and in this case, you lose money by exiting via stop loss. So you fix the loss of 50 cents, or you wait until the price recovers back. So two kind of approaches here how to deal if the share price goes down instead of. Now, maximum reward here is unlimited, potentially unlimited, because if the share price keeps going up and up and up and you never sell, you can make as much as you want. But in reality, if we see this trend, most likely the profit is also limited by certain factors, okay, profitability of this underlying stock, by technical analysis, by emotions, but market as a general, and etc. Now, the maximum risk here is $10.50 if we don't have any stop loss, and if the price of the share goes to zero and you lose all the investment money. So, okay, so we have unlimited potential and we have the loss of $10.50. That's our maximum risk in this particular case. All right, so that's how it works. Now let's compare. If we decide to use, instead of buying shares, we decide to use selling put option. So if we use, in this particular case, we can see sometimes that the share price goes to $10, and we are going to go conservatively in this particular example. So we sell $10 put option at the premium of 50 cents. Now, it means that we promised someone on the market to buy shares at $10. We kind of insure that person. That person who is buying that option from us believes or afraid, most of the time they're just afraid that the stock can go down to $9, to $8, to $5, to $0, and they want to buy an insurance. So they want to protect their downside risk. So in this particular case, they know if the share price collapses to $8, they can sell you at 10. So you incur risk. But again, so if we compare two deals, if you're happy to buy shares at $10.50, you like the share, you like the stock, you kind of analyze that particular company and you want to buy it, but you want to pay lower price. So instead of buying at $10.50, you sell a put option at a $10 strike price and you receive the premium 50 cents. Now, let's have a look where we make money in this particular example. Of course, we make money if the share price goes up. We also make money if the share price stays on the same level. And the interesting thing about it, if the share price stays above $10, that particular person is not going to sell us his shares or her shares. They're going to keep the shares, because what's the point for them to sell shares at the $10 price if the share price, for example, $10.01? No point. They'd better go and sell it to the market even if it is 1 cent higher. But the interesting thing for us, even if it goes down to, like if it stays on the same level, go high, we'll make money, it's 100%. So if it stays above $10, we still make money and we don't own the security after expiration day. But even if the share price goes down below $10, what happens in this particular case? We still can make money until the share price goes to $9.51. Why? Because if we buy shares at $10, but we already received the premium 50 cents, our break-even point will be the money we are going to pay for share minus the money we already received when we sold this option. So our break-even point in this particular case would be $9.50. If the share price goes below $9.50, we are going incurring the capital loss, because what happens here, like there are different approaches here, but ideally what we do here, we buy shares. Okay, like I mean, that's the end result of one strategy. If we sell put options, so we would have to buy shares at $10, but the break-even of that particular stock would be $9.50. So we lose money by selling shares at the market price. So if we decide to sell it at $9, for example, if it went to $9, we're going to lose this 50 cents, but we're going to lose only 50 cents, whereas in first example, we're going to lose $1.50 if we buy it at $10.50 and the price is $9. Then, or we also can wait until the price recovers back. And the interesting thing here, the price of the share has to recover back here only to $9.50, and then we start making money. Okay, whereas here it has to recover to $11.50 or $10.50 until we start making money. So the difference is $1 in this particular example, or nearly 8%. But the interesting thing here is maximum reward is here only 50 cents because it's limited by received premium, whereas our maximum risk is $9.50. So if you compare these two examples, you will see that here we have higher risk because it can go to and lose $10.50, and we have higher reward. Here we have lesser risk. It's $9.50, but we have lesser reward as well, premium. So every time when you approach the market and every time you decide which trade I'm going to place, buying shares or selling put options, you have to always compare these two things. If you see that the premium which you're receiving is really low and the risk which you're receiving quite small, so maybe it makes sense just to go and buy shares on the market or do any other strategy on that. Okay, so when you see that the premium is quite high, which reduces your risk, maybe it makes sense to use this strategy. Okay, just a second. I'll see what this laser is. That's how it looks like. Okay, that's if we lose the short straddle straight put. That's how it looks. Okay, so in this particular example, so we see the dollar value and put strike price, and that's a break-even point to expiration. So in this particular case, our risk is a bit less than if we just decided to buy shares. Guys, I just wanted to ask you, just check where our chat is. Can you please put from 0 to 10 how you understand that specific part of the presentation, and if all clear, we'll continue further. Okay, great, fantastic, great. That's kind of for the basic stuff, all right? So that's the explaining the strategy itself on a very simple terminology. All right, so let's have a look further. So why do we sell insurance? Okay, what's the main kind of idea why we're going to sell insurance or put options? So first of all, when we want to buy shares with a discount, or it can be used as an independent trading strategy without intention of owning shares. If you follow the kind of the biography or maybe the way Warren Buffett lives and what kind of strategy he uses, so you will see that in 2014 he made $12 billion by selling put options. Can you imagine if that particular person using this strategy, so it kind of gives you a hint that might be something there in this particular strategy, okay, which you can use it. Actually, after I read that article about Warren Buffett making so much money, I've started using put options practically every time before I even decide to buy shares. Even if I want to buy shares, I always consider to sell put options before I buy shares. So I kind of buying them always on wholesale and have a lesser risk in this particular case. So another strategy, a lot of people, they use it as independent trading strategy without intention to buy shares. And this is very important because majority of people who use this strategy for the second reason, they tend to use higher risk. And I've met many traders who tell me, oh, I don't want to buy shares, I just want to sell put. And because of that, they don't analyze the shares. They tell me that, Igor, look, I don't want to own shares. That's why I sell a put, and I'm selling it conservatively. I'm not going to buy the shares. And that's where the biggest mistake is made, because those guys, they don't look at underlying security. And when you choose underlying security wrongly, that's where the majority of mistakes is based. And that's why part of my today's presentation, I'm going to show you how I do it. So that's my step-by-step process. That's how I do it. Okay, and that's no secret, and you can make a screenshot of that, and you can do exactly the same approach as well. So first of all, before I do any trade with any security, I do fundamental analysis. I analyze companies' financial statements. Usually I look at the last at least 5 years of their performance. I look at a lot of parameters. I look at their sales growth, I look at the profit growth, I look at their debt level, I look at the margin, look at a lot of factors. And I have a special table which I use for my particular research, and I can identify quality companies. Quality companies are those companies who constantly growing. They're kind of increasing their market, like presence in different countries. In one country, it doesn't really matter, but they're kind of growing companies. They usually big in size. I don't deal with small or startup companies, and I put them first. That's kind of my criteria. And interesting enough, if I tell you like percentage, if you take the market tonight and you run the screener, which I use, you probably will get about 300 companies, maybe 200 companies which pass this criteria out of maybe 8,000 companies on the market. Okay, so in certain particular screeners, I use several screeners in order to identify. So it's like about, I don't know, maybe 3% of the whole market is the quality. The rest of them, they won't pass them on the test. So then the second test which I run, I find undervalued companies. And the reason for that is very simple. If I go back to previous slides, and I will show you this type of thing. I want to buy materials like lost sound. Guys, can you hear me? Can you put pluses if you...
we can, Igor.
You
stopped out for a
Okay, perfect. Okay, perfect. So what I do, I identify fundamentally using different ratios. You probably know the ratios like price-earning ratio, price-to-book ratio, price-to-cash flow ratio, price-to-sale ratio. Like there are a lot of ratios which allow me to identify that the stock at the moment is priced down. It's cheaper compared to its past performance, and also it's cheaper than its peers on the market, several companies. And I believe that usually if I look at average ratios during last 5 years, I can understand that when people kind of again fall in love with the stock, the price will go up. Okay, by doing this, by choosing the good solid companies, I know that even if the good company has some issues, some problems, in majority of the cases they keep going up because they're growing. And if this even becomes undervalued because of some kind of issues within the company or outside of company, Donald Trump something says, politics something, economically something happened. So this type of companies, they kind of tend to survive better than the rest of the market. So in this particular case, I am protecting myself by choosing specific stocks. I'm going to give you a couple examples now. Then already after that, I use technical analysis. All right, and I identify my entry level, and I presume you kind of guys know better than I do. I use only several indicators and in order to identify my entry point. So for me, it's important that it has to be horizontal or uptrend. Shares has to be at support, and indicator are in oversold position and turning. Okay, so that's where I'm entering position. So after I identify the entry point, I know that's where I want to enter, I am going to choose a suitable options only after that, and I look at parameters like high premium or low premium. How much time value has this option? Is it a high open interest on the market? Because sometimes my trades quite big. Okay, and over like I'm selling like over $1 million, and sometimes if I choose a small security, even there are no options market available for me to sell. Okay, so in this case I have to choose another security or another strategy to use to that particular stock. Okay, so I have to look at high option open interest. If you're trading, guys, with 1 or 2 contracts only, so it might be you can look at the smaller volume or smaller open interest. Another very like important criteria for me is narrow bid and ask spread, and the reason for that I'm actively trading options. So if I sell a put option tonight, I might buy it back tomorrow. Okay, I am not going to, in majority of cases, I'm not holding that position until the expiration date. Sometimes I do, but very often I don't. Every time I place the trade, at the same time I place in the take a profit, okay, action. And very often it happens within a couple of days, so instead of waiting for a month or something like that. Another thing which is a $1 spread between strikes, it means that I know that if I want to convert this strategy into another option strategy, because there are plenty of them, and I'm not only using selling put options, I'm using up to 20 option strategies, different spreads, and sometimes I change in strike prices. For me, it is important that I can do that. So that, for example, the strike price is 20, 21, or maybe even $20, $20, 50, 21, 22, 23, etc. Not 20 and then 25 and then 30. It kind of limits strategies which I can do. And now, of course, availability of weekly options. It's kind of good, and I presume if you already understand about options, options are like rent. That's the easier way to understand. So if you are running Airbnb in property market, you're getting more money per day because you're selling apartment on a daily basis, or you run a hotel, small hotel, for example, right? So you're getting maybe $200 a day or something like that. If you rent an apartment on a long-term lease, you're going to get less money per day. You are going to get maybe only $100 per day for the same apartment. So that's why I love securities where I have like weekly options, which I can sell for only 1 week. So for example, a couple of days ago, I sold like not puts but calls only for like tonight, so only for a few days. And then also when I'm selling it, usually duration of my contracts maximum 2 months. It's a maximum, but as I said already, usually I do it for only 1 week if it is possible, okay, because it's kind of higher profit there. And then strike prices could be out the money, at the money, in the money, depends on your approach. If you're a conservative trader and you're afraid that something might happen there, so you might want to go to out the money option. If you want a higher premium, it's at the money. If you want to buy that specific stock because you believe that the share price is going to go higher even after that, you just want to buy it a bit cheaper, you want to reduce your break-even point, so you might use in the money strategy. And very, very important that you have not only, I call it plan A, so how to take the profit, you have to consider the plan B as well. And tonight I'm going to devote quite a lot of time how you can protect yourself, your position, your account by knowing plan B. And you have to know plan B before you open the trade. So you can calculate your risk before that. All right, guys, that's a step-by-step guide. Okay, can you put, please, pluses or from 0 to 10, how you understand this area now? Okay, fantastic, fantastic. Just a second, I close the chat. All right, so let's have a look at the next. So I'm going to go and show you probably several companies as an example. I'm just trying to close this chat and I cannot do it for whatever reason. Just a second.
You might be able to move it to the right, Igor.
I'll probably move it here to the left that I can see that people. All right, so that's what I'm going to use. So the way I do it, I look at this type of statement. When people see this type of statement first time, they think, oh my goodness, it's so many numbers there, so I'm never ever going to understand that. But it's quite pretty straightforward. And as you can see, for example, that for this particular company, I can see the information from 2008 until 2011. So for the last 10 years, which is pretty good. And a lot of parameters, which I'm going to show you a couple of them. And as I said already, I have a special table, like spreadsheet calculator, which helps me to identify the companies with higher potential. So it's quality company and then the volume company. Now this company which provides these reports, there are quite a lot of companies in the market, and I presume you know in Australia Morningstar provides reports for United States stocks and Australia stocks as well. Because my majority of my trades performed on US market, I'm using Value Line. Value Line, the company which was created in 1923 during the Great Depression, and the main reason was to provide unbiased factual information about different companies, because at that time there were a lot of Ponzi schemes and investors were losing a lot of money. So the idea of that specific company was to take financial reports of different companies and then provide information. And I started analyzing stocks using this specific company when I heard that Warren Buffett was using this Value Line. So I thought, okay, fine. If the richest man at that time, he was the richest man in the world, and if he is using this specific company in order to analyze stocks, if it is good for him, it's going to be good for me. So that's why I started doing it. Okay, so let's have a look at 3 companies, guys. And there is a question for you. Okay, so Tesla, you have a choice. You opened your trading account and you put $10,000, for instance, there, and now you have a choice of 3 companies to entry. doesn't really matter to buy or to sell put options. Before we have to identify the company which we're going to use. So which company you are going to choose, guys? Tesla, Walgreens Boots, or Hershey? Now, if you, like, I presume you know Tesla. Tesla is a company which promotes the new type of vehicles with the electrical engine, right, which runs on the battery. And another one is Walgreens Boot Pharmacy. Its pharmaceutical chain has more than 10,000 pharmacies. It has health centers, it has medical centers, it has insurance companies within this business. It has quite a lot of businesses, okay? And then Hershey. The Hershey owns a lot of chocolate brands, and I presume you know them, and now you're chasing the trade, and you're thinking, okay, which company should I buy? Guys, the question for you, if you have a choice, what companies would you buy? 1, 2, or 3? Okay, Peter WBA, Martin WBA, all right. David Tesla, Paul WBA. Depends, Mark, depends on what? Analysis. Okay, that's the correct way. So that's the only person who answered correctly, Mark. Maybe, guys, you just like the pharmacy and you understand that kind of from okay, pharmacies, it might be good because people are always sick. But the correct answer was here done by Mark. You have to analyze the company first. You have to look what it does, okay, in financial terms, because even great, fantastic company which looks from outside with a great product, if the financial is really bad, you might lose money. Okay, and I want to show you a couple financial reports. So let's have a look at Tesla. All right, so what we can see here in Tesla, I'm going to show you only a couple, okay, drawing, I can draw it here. It's okay, so we're going to look, guys, at several parameters here. Here's cell. How can I make it thicker? Maybe here. Okay, can you see it, guys? So the yellow, this line, it's a sales performance. So we can see that from 2010, the company per share, for one specific share, it sold $1, $1.90, $3, $16, $25, $30, $43, $69, $120, $136. That's per share. Also, we can see the same type of sales growth, but when we look at a whole company, Warren Buffett most of the time looks at the bottom line below this line, okay? So you can see it here, $111, then 16, then 200 million, 400 million, 2 billion, 3 billion, 4 billion, 7 billion, 11 billion, like 21 billion, 24 billion. So what we can see, guys, here, we can see the growth in sales, but we are investors, right? So if we buy stock, it doesn't really matter how much the stock is sold. For us, important how much cash it generates, how much profit it is doing. So, and look at this. So if we look at net profit, so that's what we see. The company, like D means deficit. Okay, it means that company is losing money. So it was losing here. The sale level was 111 million. It was losing 55 million, half of what was selling. Then 150 million, more than it was selling. Then 250, then 390, then 74, $294 million, 800 million, 700 million, $1.9 billion, nearly $1 billion. So guys, what can we see here? And in 2019, they are planning to have a loss about $1 billion. So the question for you, will you buy the company if it's constantly losing money all the time? So the question is, how do they survive? How is it possible that it never ever had a profit? Why the company is still on the market? And the reason is because the Elon Musk is very charming person. A lot of people believe in him. And what he does, he constantly attracts new investors. Look at this common shares outstanding. the share amount constantly growing. So every year he issues new shares in order to attract new investors. Also, the level of debt, look at here, it was less than $1 million, and now it's $11 billion in debt company. Every year the company is borrowing and borrowing money. So where the risk here? If the company, for whatever reason, doesn't get any more investors stop believing in it, okay, and tell, okay, fine, we're going to see the profit first before we invest. Or banks will tell you, we're not going to give you any money anymore until you give us return. So what do you think, guys, will happen to this company? It's going to collapse, right? So it's going to bankrupt completely. If there are another players will come on the market with a similar type of product, and there are a lot of companies now trying to come up with a similar product, so Tesla might be financially in very huge danger. All right, so this is kind of stuff. So in this particular case, if we start buying shares on that stock or selling put options, we incur the risk of bankruptcy. We have a high risk that the company can go to zero. Okay, guys, can you please put from 0 to 10 how you understand that? Okay, this is specific area. Okay, fantastic. So let's have a look at second company. Just a second. Okay. And actually, the another thing is, you see at the right bottom corner, earnings predictability for Tesla is only 30. So it means that they are right 3 times out of 10 only, what they're going to make. All right. So for whatever reason, there are here, just how to, just a second. There are yellow marks here left. Okay, it's good because they're exactly what we need. So now that's Walgreens Pharmacy, guys. That's the company which majority of you chose. Let's have a look what here. Sales per share or sales for the company, the whole. So what we can see, it's constantly growing. If you look at the whole duration, it's growth. It's every year is growing. Okay, it has a performance from 2003, so we have information here for the last 16 years, all right? But then we also look at earnings per share, you see, per one share. So what we can see here, if we look even at the toughest time, and I always recommend to look at the 2008 because we don't know when the crisis is coming, okay, it can be very unexpected. So for us, it's important to understand how a company is going to act and behave from financial point of view when the the whole market collapses. And look what you see here. Okay, so it was $2 profit, $1.70, $2, and then the crisis started. Okay, 2008, $2.17 more, and then it slid down a bit, but it slid down less than 10%, 5% is sliding, and then it started growing back up. And at the moment, if at that stage it was $2 profit, now it has $6 in profit. And this year they are planning to have $6 as well, and then planning to go to $9 in the next 3 to 5 years. So similar story if we look at the sales amount of shares. Look at this, what happened here. They had 1,089 million of shares, and look, every year this number is going down. So they are buying back their shares. So they're doing opposite action than Tesla does. So they are actually buying back their shares, and by doing that, each share values more in the company. So after that, so this is that kind of stuff. Now, if we look at the long-term debt, we can see that the debt was 18 billion in 2016, then 12 billion, 12 billion, 12 billion, and now planning 11 and 9 billion. So we can see they are reducing that level. There was a spike here. They bought new company because very often they grow aggressively by buying different shares, but that's what you can see. And they have total debt, which is $17 billion, on the capitalization of $45 billion. So it's like close to 30%, which is manageable for this specific company. And if we know if they're making net profit nearly $6 billion last year, and cash flow is even higher, $6 billion, and they have $17 billion and in debt. How many years, if they decide to pay all the profit and cover the debt, how many years, guys, they're going to pay the debt? So if they every year they're going to give $5.5 billion to cover their debt, it would be just slightly more than 3 years. So this debt is very, very manageable. Okay, whereas in the previous company, it's kind of tough to do that. All right, so we can see it is a good quality company. Okay, very stable in this particular case. And now I'm going to show you another ratio. So P ratio. I'm going to explain only one ratio here. I'm not going to go into any other ratios particulars. But look, for instance, here, P ratio. Usually, people pay for this specific company for the last year. You can see that it's from like $20, 20 times to 11 times. By the way, before I probably start explaining, I want to ask you, guys, do you know what P ratio? Put the minus if you don't know. I will explain. If you don't know, I will explain you. If you know, just put plus. If you want to me explain, put minus. All right. So there is minus, so I'll explain. So the way it works, P ratio shows you how much you pay for $1 profit. So if the company has $1 profit, how much you are going to pay? If we see P ratio 20, it means that people pay in 2015, they paid $20 for $1 profit. Alternatively, you can have a look at this way. So can you imagine if you're paying 20 times of their current earnings, and then the company is going to make this amount of money every year from now on, how many years you have to keep the share and get this profit and withdraw all the profit to put in your pocket in order to cover your investment? 20 years, right? So in this particular case, here 21 years, here 18 years, 16 years, 11 years. So you probably understand that the lower the number, the better is for us. Look what happens interestingly, right? We look the sales level going up, the profit of the company, net profit going up, but for whatever reason here, people believe less in this company because before they paid 20 times, now they pay only 11 times. So there isn't some kind of issue there. There is something happening there around this company that makes people fearful about future of this particular company, and they're paying less, and less. And look at this now, 8.5 times. When this screenshot was made, like this specific report was made, it 8 times. If you look at the last, like all history of this company, from the beginning, you probably won't see the valuation like that. It's extremely low. Even in 2008, when the market was collapsing and everything was going down, the PE ratio was 17, 13. And now it's 8.5. So this company is deeply undervalued, and the only reason why it's undervalued because of political pressure. Donald Trump, all this was promising that he's going to go after pharmaceutical chains in order to reduce their margins and stuff like that. But in reality, like personally, I think he's not going to do, and because a lot of other presidents who were before, they always promised something like that, but never done it. Because about 30% of budget in the United States is coming from medical sector, okay, health sector. So I don't believe they're going to kill the goose, the golden goose, which kind of gives them cash from taxes point of view. All right, so this is another company, and interesting enough, if we look at the predictability rate. So they promise us that they're going to make $9 in the future. So from financial statement, if you look at $9 profit, and even if you look at average P ratio, which is like, we'll say 15 here, you multiply 9 by 15, it comes to what? About 140. So the share price might go to $140. Okay, and at the moment it's 50. So you have upwards potential if you use fundamental analysis about nearly 2.5 times or 3 times. Okay, that's how we identify that the company at a low price point now. So, and then I can see that earnings predictability is 95%. It means that practically they're right all the time. Maybe 9 times out of 10, they're correct about the earnings. So it gives me certain security that the company is going to do what they promised to do. All right. Please, guys, put from 0 to 10 how you understand this specific company. Okay. Okay. While you're putting, I'm going to show another company, which called Hershey, and a lot of people know Hershey. And this story is very similar. I'm not going to spend a lot of time explaining that. But again, sale level, constant growth, non-stop. Growing and growing and growing, right? It was selling $22 per share in 2008, and now it's $38. Constant growth. Same earnings, constant growth. If you look at every year, they even were growing in 2008, 2009. So look at this. And why? Like a lot of people say that during the crisis, people don't have money to buy a new apartment, new car, but they always have cash to buy chocolate. And they're so stressful that they go and treat themselves with chocolate. So this specific company is really very robust and stressed, kind of secured, you know. So even in the best economic time, people most likely going to keep the shares like that. Now, if you look, so this is a good company, okay. So and it has 4 billion debt and 28 billion capitalization. So it is a smaller company than the previous one, but if you look at the ratio here, it's close to what about 4-3, so it's about 12%, right? 12% debt. So not that big of it at all, maybe 15% of that. Now, then let's have a look at another parameters, evaluation point. So look at this. Usually the company is paid, like, I mean, people pay here 18 times of their earnings. So for $1 of profit, they pay 18 times. Here's 22, then 21, then 23. Highest point was in history for the last 5 years is 24.5 times. Now, P ratio is 24.3 times. Now, guys, the question for you, is it now at the lower end of its evaluation or at the higher end of the evaluation? So is it on a sale now or is it pricey now? So if you go to this emotional roller coaster, how much people paying here, the maximum or the minimum based on P ratio? What will you tell me now? Okay, who is the brave to tell it? They're paying the maximum. The maximum was 24. High, correct, Mark. So even this company is fantastic. Even the company is great financially and it's expanding, but it is overpriced right now. And yes, it might stay overpriced for a long period of time. But if something happens on the market and it goes down back to P ratio 18 or even lower, that's why I'm going to enter this position. So guys, another thing is to look at this company, the reason why people love it. Look at this earnings predictability, 100%. It means that this company, if the management tells we're going to make $1, they're going to make $1. If they tell you they're going to make $2, they're going to make $2. They're 100% time all the time. Okay, this is why people overpaying for this company, because if you compare with the previous, majority of you chose the Walgreens pharmacy, right? And at the moment people paying only 10 times, whereas here they're paying 24 times for the same dollar profit. Okay, now the question, guys, for you again. So if you know already this, even simple information, which company you're going to pick? Which company you're going to buy? Okay, out of these 3, 1, 2, or 3. You see, when you do this kind of analysis, it's give you certain oversight which company you might enter. All right. In this case, definitely I will avoid Tesla with all my cases. WBA, I love it, and Hershey, I will avoid for a time being. If the price is going down, definitely not. David is still going for Tesla, believes in Tesla. All right, and 3 fundamentally. fundamentally out of these two. Okay, correct. So at the moment we're looking only at fundamental analysis. So the reason why, because when big players come to the market, technical analysis is already not working. Like, I mean, everyone knows that you can see the trend and then there is a spike. Why the spike? Big bank enter the position and move the price, okay, and then nobody can evaluate whatever's happening in the future. You have to see again the confirmation what's happening with the trend. All right, so we've done it, we chose it. So the next step, what do we do? Technical analysis, okay. If the share price is somewhere in between the trend, I'm waiting. If it is a support line, that's where I look. So I have certain criteria. So I have to horizontal uptrend. I'm not trading on when the share going down, because it still can go down. Shares at support and I see uptick, and indicators are in oversold position and turn. So if it doesn't satisfy criteria, I just identify where it's going to be there. So if we go back to this previous chart which I had, I would say between $10 and $11.50, I might wait until it reaches $10. Okay, just wait till. Now, if it is already there, I am paying attention to different events. If I see that earnings coming up or maybe launch of new product or something like that, I might stay away from that company, because that's where the majority of moves up and down happen. Like, we don't know what is going to tell. Usually I trade options in between earnings. I don't trade options over earnings. And then already waiting until it happens. If everything is good, so I am choosing the most suitable bullish strategy for this specific company. All right, so that's practically how I use stochastic, I use MACD, RSI, I use moving averages, and that's where kind of I would enter the position once, I would enter here, and I would enter here. So, and that would be my entry point, for example, on this green candle, and I will be choosing, okay, that's what I have. I have from $138 to $149, or I have a potential risk of breaking through this trend and going down to the previous low. Okay, so 100. So I identify my risk based on technical analysis as well. And after that, I'm already trying to see what kind of options available there. So if I like this fundamentally, if I like technically, I do it. So horizontal uptrend, shares at support, uptick, and indicators are in oversold position and turning. Now, guys, you might use a different approach. You might use bar analysis and or something else. It's all good as long as you know where your entry point is, okay, because everyone. So for instance, there are two type of examples. So I can show you, you see strike prices here, 45, 50, 55, 60, okay, $5 in between strike prices. Then if you look at the bid and ask, here 35 cents, here 40 cents, here 50 cents, so it's quite huge. And then it has only monthly options, September, October, you see, so only monthly options. So when I look at another security, that's what I can see, 52, 50, 53, 53, 50, so 50 cents only between strike prices. Okay, then I look at the money, so I can see bid and ask 81 to $1.20. It's quite high as well, by the way. Here 160, 140, 137, 188. But then when I look at the contracts here, I can see that every week I can sell option, so weekly options. So if I identify between these two, I would probably choose this one. Okay, I would like that one more because it has more flexibility in this particular case. Even open interest here is smaller than in the previous one. In the previous open interest, look at this, $10,000. So you have to consider both of all of these parameters before you choose the company. So you're doing it when you have, for example, you chose Walgreen and you found another company with similar financial parameters you like technically as well. So you have to choose which company you're going to choose in this particular case. So then I developed a trading strategy. So I have to choose duration, as I told you already, less than 2 months, preferably 1 week. And then I choose strike prices. Conservative, it would be out the money, so it means that I sell below the current price, So if the price of the share now is $43, I would sell at $40. So if neutral, it would be at the money. So it means if the price of the share now $43, I sell at $43 strike price. And if it is aggressive, I might choose $45 or even higher, okay, in the money. So it's most aggressive way. Now, and remember, I have to have the exit strategy, which we're going to talk in this few minutes. Now, let's have a look at this particular example. So we can see 29 days until expiration. Current share price $52.59. It's actually the real screenshot. So, and that's, for example, at the money, we assume close at the money, it could be $52.50. All right, so I chose here 53, bit out the money, or in the money, sorry. So what we can do here, we get $1.47, right? So we get $1.47 if we sell 10 contracts. And based on total return, if we decided to buy, so it's 3.3%. So if you keep doing this type of trade, you're going to make about 39% annually if you keep doing that. Now, if all good all the time. Now, the cost if exercise, 51.39. So because you are going to buy shares at $53, minus $1.74, which you're going to receive, so it's going to be 51.39 from that specific price. Okay, so that's using already commission here, which that broker specifically using. Now, I prefer to trade without margin personally. Some people use margin with put options. You can use margin same like as your broker allows. In Australia, a lot of brokers who trade in the United States, they are not allowing us Australians to use margin in this particular case. But the good thing here, if I am more conservative about the share and I'm afraid it might go another 5% down, so I might use $51 strike price. In this case, I get 87 cents on that, and it would be 1.7% annual, or not annual, monthly return for 29 days. And if you keep doing it month after month, I will have about 20% return on that specific stock. Okay, that's how I calculate. And then if I aggressive, $55, if I believe that Nike is going to grow, actually it is grown after that. So $55, I want to buy the shares. I just want to buy them at discount. So 55 minus 295. My break even would be about $52.05, which is about 50 cents below current price. So it's kind of, I am buying a bit cheaper than the current price, about 1% cheaper. So that's the reason why I might choose aggressive one. And again, so if the share price moved during that time and closed above 55, I will make 5% on that stock. Okay, so this is kind of something to consider. All right, so that's how we calculate it. Can you please put pluses that you understand that, how we calculate this stuff? Okay, great, Mark. The rest, okay, put from 0 to 10 how you understood it. Probably because you understood some of it, but maybe not all of it. All right, so let's have a look at plan A. So as you can see, I always have plan A and I also have plan B, and plan B is actually bigger than plan A, right? So plan A, passive one, wait until the contract is expired. So we sold the put and we just wait. 29 days we wait. Now active one, we buy put back before expiration day when it makes sense. For instance, I usually set a target for about quarter. So for instance, if I sold for $1, I straight away buy back for 25 cents. If I sold something for $5, I am putting roughly about $1.25 to buy it back. And as I explained, about 60–70% of the time, I'm buying it back. So I'm closing this position way before the expiration. So I'm using active approach. But again, it's up to you how you're going to deal it. Passive is also good. Okay, so in this case, you have to consider here the amount of ways, the frequency, Volatility is very great, like the good question, Mark, about what about volatility. When I look at volatility, volatility is already included in the option premium. When I choose the option premium, I am selling options when it's high volatility. If it is low volatility, implied volatility, usually the premium is very low, so it doesn't make sense to sell puts because you collect on the very small premium, maybe 0.5%, 1% for the whole month. Sometimes it makes sense to buy shares and sell shares, or maybe to move to another security instead. There is always kind of comparison going on between different shares, and volatility is one of them which you have to consider when you place the trade. Very good question. Okay. Now, when I buy the plan B, so what happens if the share price didn't grow? So if the share price stays below the strike price, what actions you can choose in order to, to exit it? Of course, you can buy put option back with a profit or loss, because even if the share price stays lower, strike price, you can still get some profit. Do you remember when we talked about it, if you sold the put with strike price $10 and you got 50 cents, it means that if at expiration the put would be, price would be $9.70, you have to pay for that put only 30 cents and you got 50 cents. So you still might have a profit here. Now the next one, you can let shares to be put to you. So buy shares. That's what I do if I get the share price below the strike price. And then there are two options. So you can wait until the shares to grow, because we know that the company is good, solid, undervalued, it has potential to grow, and it's just the issue which is right now that pulled the price down. Or we start selling covered calls, or we do some other activities with options, which I'm not going to get at, but simple one is just start selling covered calls. Okay, another one which we can do, just a second, okay, another one, we can execute short roll put strategy. What that means, I'm going to show you, by the way, now. So you buy the existing put option with the same strike price, and then you sell another one for another month or for another week. Or you can sell with the same, buy with this, like the old one, and then sell another one with a different strike price. Okay, so you can play around that. I'm going to show you how it's done, and in this case you don't have to buy security ever. Okay, if if the price doesn't go too far away. So for instance, a couple examples. So Tenneco, you can see that here expiration, just $10 strike price, only for, now that's the trade, 14th of June and until 21st of June. So we see that it's only 1 week duration, and we get 35 cents per contract, so it's about 3.5% in this particular case, and we can see that it's expired worthless. So we didn't have to buy anything, so it just moved higher than $10, and we closed it. So then in July, so the share price went even lower, so again 12 contracts here, okay, 60 cents, and again, so we didn't have to do anything, we just fixed the profit about $2,000 in that particular. AAS, same story, but in this case, you see I bought it back, so I sold it 20th of July until 29th, now it's second, no, the trade is 29th of June until 20th of July, so about 20 days, and look, I sold it for $2.65 and I bought it back for 50 cents. Remember I was telling you about quarter of that, and I did it 18th of July, so 2 days prior to expiration. I exited my trade, I paid $350 and fixed $1,500 profit. So the same in August trade, so one contract sold for $1.7 and bought it back for 50 cents. So that's what you do all the time. Here story as well, for $1.80 I sold, and 4 days later I bought for 30 cents. So majority of trades, that's the plan A, that's what you do. You constantly sell and then buy, and you fix the profit and do another trade. Okay, that's how it is. Now, can you put plus, guys, from 0 to 10, how you understand the plan A, and then we'll continue to the plan B in this case. Okay, great. So, plan B, we bought the stock. So what do we do with that? As I explained, we can just sit and wait until it grows and we'll sell it with a profit. And we know that it's most likely going to go because we chose the correct stock. Fundamentally, the crucial part of this strategy is to choose the proper security, underlying security. But if you bought something and then you want to collect the premium, you can sell covered calls. Okay, in this particular example, you can see that the share price, for instance, $14, and we can sell and collect 45 cents for 5 days. Only duration is 5 days. Okay, and in this case, we collect about 3.2% profit. Or we can go for 33 days for $15 strike price. So we can choose the higher. So instead of selling at the money, we can choose the high and get 65 cents. So we get 4.3% if the share stays below $15, or if the share grows above $15, it's going to be taken from us because it's a call option already, right? And in this case, we'll make 10%. So you can choose whatever strategy is suitable for you in the specific case, but again, you have to understand how to operate. If you don't know how to do that, I definitely recommend to learn it first, to practice on simulators, maybe for 6 months or something like that, and only then when you see the profit on simulator, on virtual account, then only to move to real world with the kind of activities in this particular case. Now, that's how you do with call options. By the way, guys, do you know call options? I presume Sam explained it several times in the different ATAA meetings, and I presume we've done a webinar as well, how to explain. Now, this rolling strategy, I actually didn't know about that when I started. The way I did before, like in the early career of my trading experience, I was just buying shares. And then once I saw that, I thought, oh my goodness, it's a gold mine. Because look what happens. That's, for example, the strike price. The current price is, what is that, about $14, something there, close to that, between that, somewhere here. No, below $15, definitely. So what happens here? So we would have to buy the shares at $15 if we chose $15 strike price. I don't want to buy shares at $15 for whatever reason. I don't know the reason, but I just don't want to buy. So what I can do, I can buy back that option for $1.30. Again, we are not looking at how much we sold it for. We might sold it for $2. In this case, we made profit. But we also might sold it only for 50 cents. In this case, we are going to lose 80 cents. I don't like losing money. I like making money. So in this case, what do? Instantly, at the same moment, it's actually put as one trade. Okay, it's short roll call, rolling naked put. So what I do, I buy it for $1.30 and instantly selling another one for the next duration, for the next week or next month, for $1.65. So how much do I make here? I make here 35 cents on a $15 share. Okay, so if I do term contracts at $350, it's about 2.3%. Now, guys, can you please put pluses from 0 to 10, how you understand this specific strategy? That can make a huge difference for you from psychological point of view. I explain you why. Because a lot of people, they don't like to sell shares lower than they purchased it. And very often they're waiting until the share price goes up in order to sell covered calls. So, and very often people just get paralyzed in the market. They just sit and watch their red account, which they don't want to have. Okay, but if you know the strategy, you actually never have to buy the share. You can roll it and roll it and roll it and roll it. In some cases, I had like nearly 5 or 6 rolls, like in a period, 6 months in a row. Okay, in this particular, okay, then you pay the ask and accept the bid rather than trying to get the midpoint prices. Of course, Martin, I'm a bargaining person. At the moment, I just explained you, like even if you go just for bid and ask, but here look at this 20 cents difference. Very good question, by the way, Martin. And here I can see 15 cents. So I will start, and actually I'm trading using an interactive broker. They have their special feature. They will start practically from the opposite. They will try to kind of buy it for $1 and sell for this one. And then they start kind of by using 1 cent. You don't have to do it manually. They will find the best price. Yes, in Australia, the premium is quite high. I agree with you. That's why I do US stock market. But for you guys, it's very easy. I mean, I use interactive broker for myself. Commissions are absolutely low. I mean, for one contract, I'm paying $1 only. Okay, if I buy or I sell $1, that's it. $1.65 for different securities. And the interesting thing that if I want, I can buy Australian stocks as well using that broker. So that broker allows me to trade 32 markets. I can trade Asian market, even Russia opened recently. I presume you understood from my accent that I'm definitely not local, and you can do that stuff. Yes, interactive broker. No, this one is actually, these examples I've done from Option Express. Option Express is now bought by Charles Schwab's. The platform a bit changed, but also quite good one. But Charles Schwab's, they closed recently, about a couple months ago, the office in Australia. And if you open, you still can open account with them, but now you're going to deal direct with America now. And Charles Schwab's is charging $0 right now. But Peter, I'm not sure. I don't know, because one of my colleagues, traders from Israel, he called to Charles Schwab's and asked them if he switches to them, if he's going to have zero commission. They told him no. They told him that it's only for US citizen. I'm not sure, Peter, did you check that Charles Schwab's is charging $0 for Australians as well? Because I'm trading Schwab's, I'm not sure, I just didn't check. I haven't created trades recently there. I just have long-term security there. It's kind of my dividend portfolio in that specific company. Schwab's is $0. Okay, great, fantastic. Because I heard they announced about it not so far away, from 7th of November. I think 7th of October, 7th of November, they charged $0 commission, but I wasn't completely sure, is it for Australians as well or just only for US? All right. So, but it is kind of good. For us, for traders, it makes a lot of sense, because, I mean, we'll save a lot of money on that, on the commission. Ameritrade, but only US customers. All right. Only US. Okay. Okay. In any way, guys, I mean, brokers, they have to make their money too. They provide a fantastic service. If you remember 90s or like, I mean, early 2000, you probably remember that you have to call a broker and the commission was huge, I mean, crazy, the amount of money you paid for in that particular time. Now, like, it's so cheap, it's just unbelievably cheap. I mean, I remember when I was starting and I was charged like $20 for trading options, even if I was trading with one contract, and now it's $1.60. It's like, and you're saying now it's $0. That's absolutely low. Okay. Not only because of that. I mean, I analyze, recently I ran analysis on E-Trade business, and if you look at financial reports which they provide, half of their profit made from providing margin. Nearly half of the profit, not from trading activities, but from providing margin, because majority of people using margin and the trade using margin, and so that's how they make money. So kind of this is kind of advantage. Okay, guys, as a summary, what I'd like to say, focus on your profits, but protect your capital. Always think about choosing the quality companies, choosing undervalued companies, and selling puts or support only, and always have a plan B. Remember, if you fail to plan, you're planning to fail, so don't do that. And I've met many people who use like, oh, we're going to use only this time for bad company, which going through the court process, they're sued by somebody, and the option premium sometimes 10%. They're going, I'm going to risk and get 10% on that specific security. And Murphy's Law, it's like Irish law. I lived in Ireland for 11 years. They say whenever you're trying to grab a bargain, usually it's kind of, there is a trick there. So, and usually when they sell like this high profitable option, then something definitely happens there, and the share price collapses 40% on the kind of bad decision. Yes, they made 10% out of that, but then they would have to sell covered calls for the next year or two in order to recover their losses. So please be careful when you're choosing this strategy. Choose the underlying security correctly. All right. So guys, do you have any questions? You can ask me. I will try to answer in the best way. Now, if you want to learn something more, I have this Sydney Traders and Investors Network, so you can go to Meetup and type it, Sydney Traders and Investors Network. All traders welcome. Sometimes we just run meetings, we just go in for a drink or something like that, sometimes educational seminars, webinars like that or whatever. Also, recently I was running a webinar, also it's called Pros and Cons on Investing in Pipeline Industry. And the reason why I just put there, just to show you how I approach the financial analysis, because that would be about 1 hour of pure financial analysis of the company and technical analysis as well. Now, usually it's just for my members only, for our investment club members, paid membership, but guys, just for you, just this one you can watch yourself and see how it happens. And of course we have another event where I explain combination of option and value strategies and show different kind of maybe trades and stuff like that. So you can go, if you go to globalinvestmentacademy.com online event, also free. You can have a look at this. If you like it, you can learn more about that. Now, and if you have any questions, guys, just email me info@igorvasiliev.com, or my mobile number is here as well. So very often my mobile is on a silence because when I'm working I try to avoid my mobile phone, but if I see the missed call or I see the text message, I will return your phone calls. Okay, so thank you very much for devoting your time. Thank you very much for coming here and standing with us for nearly 2 hours, right? So what's time? 1.5 hours. And I hope that this information will be useful for you, and you might use some tricks and tips from it in your trading career. And of course, I wish you great profit on the market. And as always, tell that, look, guys, remember, we can make money on the stock market, but the most important, we enjoy it. Okay, that's why I love this area of activities, because it gives me not only financial security, but also a lifestyle which I want to choose. Okay, so thank you very much for coming here. Thank you very much for your great questions, and I am passing my back to Daryl. Okay, thank you very much, Daryl, for inviting me as well.
Well, thank you very much, Igor. I think everybody would agree that you have given so much tonight. I think more than any other presenter. I know it's not a competition, but you have been so generous. And this is a strategy I love. I love doing Plan B. I roll over my options as well. But I just would like to make a note of warning. Please, these strategies you should only use after you really know them. There is a risk with any option strategy, but what Igor has shown tonight is the most important part of that is looking at the risk and then having your plan as exit, and that's as simple as that. So once you know what your strategy is going in as to how you're going to manage it, then to me, I just love them. So a special thank you, Igor. I know that I think Tim Young was asking, and probably people do ask all the time, where will the recordings be? So this is being recorded. We try to put them up for viewing, typically on the website. It's just undergoing some major surgery at the moment, but we're hoping by Christmas that surgery will be completed and there will be healing. I know that Warren, the President, places the recordings on the ATAA Facebook page, but please, if anyone's got any problems, if after a week you can't see the recordings on the ATAA Facebook, please don't hesitate to contact me. And please, take up the offers that Igor has generously given tonight to follow what it is that he's doing, because he is the man, as far as I'm concerned, with put options. So thank you very much once again, Igor. Really appreciate it. And good night, everybody. Good night.
Okay. Good night. All the best. Bye.